Okay, this is Dr. Moore again. We're back to continue on the coverage of the Global Asset Management Education Forum Conference. In case you missed the first video and jumped straight to this one and are wondering how we got here, we can start off by going to my website, efficientminds.com. Over here where it says seminars, just hover over that. When you get to Game 4 Conference Notes, click on it. And then from there, click on this rectangle, make it full screen. Get rid of this little banner. And we left off, we were about to discuss the global economy. So if we can jump over there, global economy, there. Okay, so the globalness. A couple presenters, throughout the presentation you'll see two-letter initials. You could go over to the Game Forum conference website to find out exactly who these people are, but these are probably more for me than for you. Just a note to myself who commented on what. Numbers from China about their growth rates are suspect. So one way to get around questionable numbers is to use numbers from non-China sources. For example, import-export numbers with their trading partners. One guy even made a comical comment here that he tends not to believe economic statistics from communist dictators. I'll let you judge the merits of that statement. There's going to be inflation in the future since long-term rates have risen. Could be shown mathematically using expectations theory. If you want to learn more about expectations theory, you can go to my website and over here in publications and financial institutions, you'll buy my book, and in there's some discussion on how to extrapolate expected future rates given the yield curve. At any rate, I found this very interesting. Do corporate profits originate domestic or abroad? And it turns out most of the profits from nearly half of S&P 500 revenues come from overseas. So even though these are U.S. companies publicly traded on United States stock exchanges, the half of the revenues of these companies are coming from abroad. So that's something to definitely be mindful of as you make your investments, and in particular if you're considering correlation and how correlated the returns of a company that gets half its profits outside of this country, its returns going to be correlated with the returns on the stock markets in other countries. The disconnect between S&P 500 and U.S. economic growth could be attributed to these revenues. For instance, it's often been said that the stock market is a leading indicator of future economic growth. Right? Stock price reflects the present value of all expected future cash flows. This is true, but if those are cash flows from other countries, we can't necessarily imply from a rise in the S&P 500 that means a rise in the U.S. Market. Exchange rate's volatile, we know this. So when you're discounting future cash flows, you're adding another layer of complexity. What are the exchange rates going to be going forward? So when you do receive those cash flows from the Japanese company in yen 5 years from now, how many U.S. dollars is that going to be? That's going to be a significant exchange rate risk and a little bit of complexity to your model. All right, what some of the, actually make sure I didn't miss anything here. No. Okay. So what are going to be drivers of growth here? There's $7 trillion still in cash on the sidelines. I believe the presenter mentioned this was money still in money market funds. Unfortunately, if you were fearful and missed out on market gains because you sat on cash, you would have missed 32% return last year. I thought it was interesting that one panelist recommended the consideration of global real estate investment trusts. In some of those countries where real estate markets are really depressed, we're not going to go over there and buy a house, but maybe you can invest in a company that specializes in real estate in those foreign locations that have been depressed. There's a beige book that has comments on the economy from the Fed. Then there's an orange book, which aggregates comments from earnings call and conversations with the CEOs. And then the writer of this orange book comments on that. They made a point of you should compare those comments with your analysis. So if you think a company is going to grow a lot, and then you look in the orange book and see comments from suppliers and customers of that company, and they're saying no revenue growth selling to company XYZ, you need to take that into consideration. Another comment was middle income earners drive the economy, but unfortunately middle class is underemployed. I learned a new term during the conference, ninja loans. That's loans for people who have no income, no jobs, or assets. An example would be student loans, and those are looming large. There were some comments on student loans again in this conference. Energy, competitive weapon. So there's some belief that we're going to be a net exporter of energy period by the end of 2015, and it'll be driven largely by energy. That will remain to be seen. As far as weightings, specifically in the energy sector, they suggest, one presenter suggested underweight integrated oil companies and overweight the U.S. in general. Energy demand is overstated, but still part of the picture. One person's comment, there was some debate on whether energy demand is going to go up or down. On one hand, the population is increasing, we're using more energy. On the other hand, we're becoming more efficient with our use of energy. So when looking at companies, who's going to benefit from lower energy prices? For instance, who uses a lot of natural gas in their production process? Because natural gas prices, as we bring more and more production online, looks like it's going to go down. The differential prices for energy may not be sustainable. Energy is a source of growth over the next. I guess I have a little typo here. Energy will be a source of growth in the future. Let's just make it general because I guess I missed something there. Sorry about that. Next 10 years. Maybe that's what I meant. So where's growth over the next 10 years? It's going to be hard to find without emerging market growth. However, right now, if you look at financial statements, wait a minute, I'm jumping ahead. Consider multinational companies that are involved in emerging markets. Consider U.S. multinational corporations because they have some economies of scale and some prior experience in emerging markets should be a good play. Emerging market share has risen. Number one issue with regards to growth here in the United States, one person comments, the aging population. We're getting older, and so healthcare costs associated with that. Where are we going to work as we get older? Is that going to crowd out, squeeze out opportunities for the younger generation? This is an issue. Markets have risen partly due to cutting of labor costs. However, when you cut labor costs, you cut consumption dollars. And if you think about the earlier slide here, where actually way back here, where I said the middle class is struggling and shrinking, this is related to the cutting of labor costs is related to the shrinking middle class. Frontier economies look safer due to better debt to GDP ratios. Orange book. We had some really cold weather here in the United States this winter 2014, and a number of CEOs in their conference calls attribute poor performance or lower revenues to bad weather. Some use it as an excuse. Some it's a valid reason. You must take time to know which is which. On housing, concerning factors, there's record low mortgage rates, but no significant growth in housing. Again, this would tie into the struggling middle class story. But you could also see how this would help the 1%, right? If mortgage rates are low and you already have money, you can buy more properties and save even more money on interest. But if you're struggling middle class, trying to make ends meet, you're not going to go buy a house even if the rates are low. This secondary market for mortgages, even though Fannie Mae and Freddie Mac are falling to the wayside or going away, there's going to be some government involvement in the secondary market. They didn't articulate exactly what that will be, but there will be a secondary market and there will be government involvement. Single-family home occupancy has been falling again, related to the struggling and shrinking middle class. Can't buy a house, might as well get an apartment. Townhouses and condos use less lumber but have really nice kitchens and bathrooms, according to one presenter. And he asked the question, who's making this stuff? Apparently, that might be a good investment. There's companies that make fancy faucets and dishwashers. I don't know. People can't buy homes because income has fallen. That's obvious. One guy even said short home builders. The quantity and quality of buyers is concerned. There's not a lot of qualified buyers. Who's going to buy these new homes? Okay, moving on. Monetary policy. The notion of rising rates, one person here said it's good for the economy. Quantitative QE was hiding problems in the market, quantitative easing. Might as well bring it to light and fix them. People have searched and stretched for yield. So seek total return, not just yield. However, munis look attractive. So this bullet point here is saying don't buy just based solely on the highest yield to maturity. Consider after-tax considerations. Consider short-term bonds, because long-term bonds, the value of a long-term bond will drop more than the value of a short-term bond. So even though a long-term bond may have a higher yield today, you may be locked into getting a small coupon payment going forward, whereas you can get a lower yielding short-term bond, and then as rates go up, your short-term bond will mature and you can reinvest at the higher rate. Okay. Regarding the euro, remember academics predicted that one monetary policy with multiple physical policies would not work. I don't think you need academics to predict that. Without Germany, Eurozone collapse, that's kind of pretty obvious there. Let's see. When economic indicators are suspect, change what you look at. This was related to those comments about growth rate estimates or any economic numbers coming from the government of China. Look at other things. Or even when economic indicators from our own government look suspect, look at other sources of data. One person mentioned the true bottom line are corporate profits, but we've had Enron and Enron and WorldCom financial accounting scandals, so I think we're past that with some regulations such as Sarbanes-Oxley, but just make sure you not only look at the earnings number, but the earnings quality. You can Google earnings quality on your own. But I do tend to agree corporate profits are perhaps one of the best indicators. Just make sure you compute them for yourself. And be mindful of government involvement in biotech companies. I mentioned that in the introductory presentation. As cures for various ailments are discovered, the discoverers of those ailments want to make profit, while the government wants people to get healed. So there'll be a little bit of a conflict there that will have to be resolved. Finally, on the middle class, there was we talked about ninja loans, no income, no job or assets. One presenter suggested that's the next subprime crisis. They also mentioned choose the right major to maximize return on investment. This could be taken as an offense to any liberal arts major, but the truth is we need more STEM majors: science, technology, engineering, and mathematics. I think that's what STEM is. We have 1/3 the number of those majors now than we did in the 60s and 70s, and we've been losing our competitive edge in this country. So, and those jobs tend to pay more, right? So, not that we don't need, say, for instance, English majors or social workers at high schools, but the return on investment, education is very expensive now, and you just at least be mindful and know what you're getting into when you choose your major. Be mindful of, okay, after spending X dollars on my education, how many dollars will I earn? One guy suggested college is not a right. I'm not sure how I feel about it. It's a right that anyone who gets good grades, I would say, or anyone who's putting forth the effort. But that's a complex subject that really wasn't the focus of the conference. There was an interesting exchange here between these two gentlemen. This comment was made: shrinking middle class is a problem. Another person said retail sales are up. There is no problem. But okay, retail's up, but what retail? All these high-end stores are up. But and who shops at these high-end stores? Not the middle class. So pretty interesting exchange there. We almost got a little bit of conflict there, but I tend to agree. Well, I shouldn't say agree. I see how both of these comments can point to the same reality, right? The middle class is shrinking. There may be some at the upper end of the middle class that are transitioning into upper class that are going to Neiman Marcus, but I think there's fewer of that. I mean, retail sales is up, true. Shrinking middle class is a problem, true. Both are true. Okay. At the end of this session, the moderator asked, what are some of your biggest personal mistakes? One person said too focused on valuation. Another one formed a hedge fund at the wrong time. Another one had a contact at a clothing company, I think later became Gap, and he didn't talk to him or remain in contact with that person, and failure to stay up to date on great ideas. So keep yourself up to date, stay in tune with your contacts, and be mindful of timing. Okay, that's it for global economy. And at the end of this video, I'll save the next section for the next video.